And then Judy, here's the I'll just pop it in the Zoom chat. Here's the Slido chat, so then people can anonymously ask questions. So I'll talk about that at the start as well.
Awesome.
You're going to drop that in the link though, yeah? And on YouTube?
Yeah, we are now live. So hello for the people who have joined us or are watching this on record. We're just going to give it a couple of minutes before we get started with the first of three webinars. Judy, here's the pop it in the Zoom chat. Here's the Slido chat, so then people can anonymously ask questions. So I'll talk about that. You guys hear that?
Yeah, I think Judy, I think you're watching it on YouTube as well. Drop that in the link though, yeah? And
perfect. I've deleted the YouTube, so that should
perfect.
Sound. Sorry.
The inception was I was struggling.
I was like,
for those who have joined us, we'll just give it a couple of minutes before we crack into today's webinar. It's the first of three that we're doing this week. Today's all about buying your first home. We'll do probably 30 minutes of talking if Mike and I can be well behaved, which to be honest is quite unlikely.
Cut down on the intro. You always spend about 2 hours doing the introduction.
I love the intro. You know I'm a hype man. And then we'll do Q&A, which I'll talk about in a second.
Yeah. Amazing. Well, how about we give it till 2 o'clock, so like another minute, and then we can kick off from there. But there's always kind of like pauses as everyone gets online. It's so awkward, aren't they, when everyone just sits here silently?
Yeah, it's funny because you sort of, different businesses everyone operates differently, but you see, like we see really clearly, like the difference is when people log on between individual businesses. Like the lawyers are always like 5 minutes late, like, you know.
Yeah, and we would have seen that when I was at Russell McVeigh. I think everyone's 5 minutes late for every single meeting because everyone's so busy and so important.
Yeah.
Amazing. Well, hey, we've hit 2 o'clock. So in the interest of keeping to time, I'll introduce you guys. So, hey, look, to everyone who's joined, I just want to say thank you so much for taking the time out of your day to sort of come on board with this. I know that it's something that you can always feel, actually, you know, something else has come up and a client demands come up and you want to sort of put it off, but actually this is really important. And I think that just giving yourself an hour to, you know, get your finances in order is really, really important. So really excited to everyone who's here, and thank you so much for joining us. I am quite a big fan of James and Michael's myself. I'm going to give them a little shout out to their podcast, Checks and Balances, which I listen to on my walk, and they've got some really nice advice. And I think the nice thing for me about them as well is that in addition to sort of giving some good advice, they're actually sort of young and a little bit more relatable and a bit realistic. So I think that that's a nice touch as well for it. So without further ado, I will hand over to you guys. But thank you so much for being here and doing this with us.
No worries, Judy. Thank you very much for having us. Mike, from 1 to super pumped, how pumped are you for this?
I'm very pumped. I'm also very pumped I just got called young. That was great.
I know.
Like, that's not how I feel after I go to the gym, but
yeah. I think I'm actually just showing that I'm also not young, but I like to think I am.
Yeah. Great. All right. Well, we've got our slides up and running, so I'll crack into it because the chances are we're going to run a little bit over time because we love doing these so much, but we'll try and be well behaved. Judy, I'll take you off as co-host. Farewell. Cool. So everybody, thank you for having us today. So I'll go backwards. So my name is James Blair. I'm a financial advisor. I'm joined by my very capable, good-looking co-host, Michael Vincent, who is a mortgage broker. At Lighthouse, we essentially give financial advice, and our purpose as a business is to secure your financial future. So between us, Mike and I have about 20 years of experience helping people buy their first home, invest money, protect their family members, come up with a plan and go, where do you want to go? What's important to you? We've run these webinars with probably 3.5 coming on to 4,000 people over the last year. So businesses like Simpson Grierson, Russell McVeigh, Rocket Lab, Zero, WSP, Engineering New Zealand, a few more as well. We love doing it. It's probably, Mike and I say that if we could do this full time, it would be great. The the format for today is we'll talk for about half an hour, and then there'll be as much Q&A as you want. There will be a link either in the chat or in the description soon for Slido, where you can ask anonymous questions. It's just a little bit better than the YouTube chat function because it means you have to be signed in and you can't ask anonymous questions, etc. So you can use that function when we get it up and running. And today we're doing first home. Tomorrow we're doing mid-career paying off debt and creating wealth. And then Thursday, are we doing Investing 101, Mike, or planning for retirement?
Investing 101.
Yeah, great. So it's really important. You've given us some of your day. We want to make sure you get out of today what you're looking for. So we love questions. I don't want to say we compare businesses and have preferences and favorites, but definitely our favorites are the ones that ask the most questions. So get in there. There's no silly questions. Off the back of today, straight after this call, we'll send you an email with a survey link to let us know how you found today. And also you can book a free 30-minute consultation with either Mike or myself or one of the team at Lighthouse. We're based on High Street in the middle of the city in Auckland, where you can have a chat about your own situation. And the format for today as well is it's not, we're just providing information. If some of you want to have a chat with us off the back of that, that's great. Okay, I've touched a little bit on Lighthouse already. Essentially, we've got 3,500, 4,000 clients, similar number to the surveys, pure coincidence. Accounting, mortgages, wealth, and insurance are the parts of our business.
Cool. So because we are giving information today and we'll give some advice, we just need to give a quick disclaimer because we're both financial advisors. So look, this isn't personalized advice. We are just talking in general terms. If you would like to discuss your personal situation, we're happy to just book a time, sit down, answer all of your questions that we need to give advice on. There may get to a point in the questions, if you're asking things like, I'm 28, my partner's 27, I earn this, they earn this, what can we buy? That's personalized advice. So we just can't answer that. We need more information or we end up giving you incorrect advice. We will push it as far as we can though. Neither James nor I like sitting on the fence. So I will try and give an answer to everything. But the other thing to keep in mind is there is a lot of things to consider when you're buying a house. I'm going to try and give you as much detail as I can without just absolutely boring you. Just ask questions if you think I've missed something, if you've heard some jargon that you want me to explain or something like that. It's, the more questions, the better.
Cool. Okay. In the description now of this YouTube video, there will be some links. The main one that I'm really keen for you guys to jump on and have a look at is the Q&A Slido link. So make sure you jump in there, maybe say hello or pop something in there just so we know that it's working and you guys are up and running.
Cool. So the agenda today, we're going to talk about setting goals. Now, I know this is about buying your first home, but if you don't know where you're wanting to go or what your goals are, how are you going to get there? And setting goals is a really important thing to do. We'll run through how we set goals, a couple of things about them as well. Budgeting. So we know how we want, we know where we want to go. Now it's about how we're going to get there. And budgeting is a really useful tool on how you can achieve that goal of purchasing your first home. We're going to run through some KiwiSaver stuff. I'm going to talk about it in relation to purchasing a house, some things you need to know and should consider. I'll then go through the home buying process. Now, this is a really big topic. I'm going to give you the key points that I think you need to know. Again, just keep asking questions. I'll just keep answering them. And then we'll talk about insurance at the end. It is important when you take out this amount of debt to purchase a house that you think about your risk position and the risk position of your partners and your families and that sort of thing. So we'll cover on insurance as well. So 46%, it's a big stat. What is it? This is how many, the percentage of Kiwis that are uncertain about their financial future or about making a large financial decision. This is one of the key reasons why we run these webinars, is to try and improve this stat. 826,000, that was the median house price in New Zealand in 2021. That is a lot of lettuce. So we're going to talk about strategies about how you can afford these sorts of houses. But we know that on average, houses grow at about 5% per annum. So that means in 10 years' time, the average house price is going to be 1.35 million. This is why we encourage people to get on the property ladder as soon as possible. And absolutely, there might be some short-term dips and plateaus and these sorts of things in house prices. But on the long term, we know how they grow and what the trend is. And you're going to be looking at 1.35 million for the average house soon.
Okay, so let's not get this twisted. Today is about buying your first home. This is Mike's show. He's the mortgage broker. I'm just going to touch on a couple of things early around setting goals. So I'm not sure for those on the call in terms of where you're at. I assume you probably haven't purchased your first home, or maybe you were on this call for somebody else. If not, if you're early in the journey, the first thing you need to do, just like any good financial plan, is thinking, what does success look like? How are you going to know if you're achieving your goals or not if you haven't written them down and broken them down? So we recommend that you set, there's kind of 3 stages to setting a goal. The first is getting it out there and going, I want to buy a house. Telling the universe, writing it down, getting it moving, opposed to it being something in the back of your head niggling you is important. Then you need to be thinking about, well, what kind of house am I going to live in? Let's say, for example, you buy I know it might be difficult, but $1 million house, and you need a 10% deposit according to Michael Vincent for that specific situation. It will depend on your circumstances. A 10% deposit for $1 million is $100,000. So from going from thinking about wanting to buy a house, you've got a more tangible goal going, I need $100,000 as a deposit to purchase my home. Let's say that 50,000 of that's going to come from your KiwiSaver, which means you need to save $50,000 over a period of time. So if we break that goal into just going from like, geez, $50,000 is a big unattainable number, you need to work it back all the way back to, on a pay cycle, how much money you need to save to achieve your goal. So for example, if you wanted to buy a house in 2 years' time, that means you need to save $25,000 a year. 25,000 times 2 is 50. And then per paycheck, if it's on a fortnight, you might need to save $1,000. Now, $1,000 a fortnight saved for 2 years, you'll get to your 10% deposit. If that is not achievable, you need to change the goal. And that's why planning these things out and making them measurable is so important. So maybe you need to buy a cheaper house. Maybe you need to save longer before you can purchase the house. Those 3 steps are incredibly important. Getting it out there that you want to buy a house. How much is that house going to cost? What is the deposit required? And then how much do I need to save each fortnight to get there? Now, obviously, a big part in that as well is budgeting. Budgeting, I don't know what you think, Mike. I feel like it's got some dirty connotations.
It's a bit of a bad rap.
Yeah, you're trying to control me. You can't control me, Michael. I want to go out and live my best life. And essentially, it's all a decision at the end of the day, how you want to spend your money. Now, there are a million different ways you can budget. You can have a spreadsheet. We really love a tool at Lighthouse called Pocketsmith. They're a Dunedin-based company where essentially you can pull in your bank transactions, categorize, set budgets, all really good stuff if you want something nice and simple. But maybe you've got a spreadsheet, or for some of our clients, we just recommend the 3 mason jar approach. So this is really keeping it simple, automated, and sustainable. Sustainable is important, and that's reflective of the fun jar, is, if I want to get abs by summer, eating chicken, broccoli, and rice, I might do 3 days in a row and then hoe down, 3 sales pizzas. It's all about having balance in life and making sure you can do the things that you enjoy. Mike and I love going out for breakfast. A good tip in there as well in your financial plan, get the other person to pay for breakfast. That's a great way to save some money as well.
Never pay.
So you need to first understand, in the scenario where you're trying to maybe save between you and your partner, maybe $1,000 a fortnight. First, you need to understand your fixed bills, have a bank account or automatic payments where your fixed bills are automatically going out. Then once you've got your fixed bills, you need to have a separate account for your savings. This needs to go somewhere. It can't sit in the same account. Some people wait until the end of the fortnight and see whatever they've got left over. There's no accountability. There's no structure there. The money needs to go straight away. And then whatever is left over is the fun account, is what you've got to live off over the next fortnight. We do not dip into the savings jar when we run out of fun money. that is left separate. That is for future you.
I think a really important point on that one as well is, is around making sure it's automated. The more interaction you have with these, with the savings plan. So if you have to manually shift money from this jar to this jar or this account to this account, the more tempted you are actually to just, maybe we won't put so much in savings this month. And that's the type of thing that will extend the time until you're actually achieving those goals or sort of derail you. So really important to keep it automated.
Okay, so part of it is you and your savings. The other part of your deposit these days is your KiwiSaver. Mike, what would you say the average percentage of a deposit is KiwiSaver these days?
At least 50%. You probably more, but at least 50%. 50%.
Yeah. I mean, from something that wasn't around 15 years ago to being such an important part of people's deposits to get onto the housing market, it's a big amount, which means that even outside of buying your first home, if KiwiSaver is going to end up being one of your biggest assets come retirement, you should know where it is, what fund it's in, and how much you're contributing. Just to give you a really quick example of why KiwiSaver is so important for you, let's say you're 20 years old. I know there's no 20-year-olds earning $80,000, but their average income across their working life. If you are contributing 3% into a default fund, you've got nearly 600,000 by the time you're 65, 900,000 if you're contributing 6%. If you're in more of like a medium risk fund, you might have anywhere between 850,000 to over 1.3 million. And then some of the aggressive funds where it's going to be a lot more volatile, there'll be periods of negative returns. You could end up with as much as up to $3 million in this particular scenario. Now, Mike looks at these numbers and goes, aggressive 10%, that's for me. That is not the purpose of this exercise. You might want to use those contributions somewhere else. You might not be comfortable with the big ups and downs. It's just an example of how big of a difference KiwiSaver can make to your situation.
All right, now that we've got the boring stuff out of the way, buying houses. Cool. So KiwiSaver, great tool to purchase your first home. Like I sort of said before, we are really, most of the time seeing people with at least 50% of their deposit being in KiwiSaver. There are some conditions and things you just need to consider though when you're looking at using it as your deposit. So you need to have been contributing to KiwiSaver for at least 3 years. Now, this isn't 3 consecutive years. You could do 2 years, go off on an OE to London, come back and do another year, and that would get you over that first condition to be able to access those funds for your deposit. You need to be buying an owner-occupied property. So you can't be buying an investment property and using your KiwiSaver contribute to the deposit. And reasonably speaking, it needs to be your first house. There are some instances where people may be purchasing their second home, but they've got divorced or separated, or for some reason they've lost the house or the business, and they might be in the same position as someone who is purchasing their first home. They can also access it, but by and large, for 99% of people, you need to be purchasing your first home. There are some other conditions in there, but those are the main ones. Really important sort of, or easy way to find out is actually just to email your KiwiSaver provider and just ask them how much you can withdraw for a first home deposit. And they'll usually let you know pretty quickly if you can withdraw it for a first home deposit, and then they'll give you the balance that you can use as well. Now, there's 2 deposits or 2 sort of ways that you can use your KiwiSaver for a deposit. You can use it on your purchase deposit. Now, a purchase deposit is the deposit that you pay right after you win the auction, sign the sale and purchase agreement, purchase off plans, whatever you call it, or however you purchase the house. It's the deposit you pay straight away. It's usually between 5 and 10%. Now, keep in mind that KiwiSaver can take up to sort of 10 working days to access, maybe longer, depending on who your provider is and how slick they are. And then it can also take time to go from the KiwiSaver provider to your solicitor's account to actually pay the deposit. So if you're going to be using your KiwiSaver to pay that initial upfront deposit, you need to make sure that your estate agent is aware, your solicitor is aware, and tell your KiwiSaver provider in advance as much as you can. Because otherwise, everything grinds to a halt when you can't pay that deposit. The second place you can use it is on settlement, as a settlement deposit. Now, this is the balance of the deposit that you pay when you settle the property, so a little bit later on. Now, this sort of, it's essentially just a different bit of timing. But again, you just need to make sure that you're giving your KiwiSaver provider as much sort of notification as you can, because it's still going to take 10 days. And what you don't want to do is to be trying to settle a property in 2 days, and your KiwiSaver provider is coming at you going, I can't get these funds out in that time. You're going to be charged some penalty interest. So just make sure, check the conditions, see how much you can withdraw, and then give your KiwiSaver provider heaps of notice that you're going to be using it. Cool. So I'm just going to cover off the first home buyers grant pretty quickly. This is an amount of money that the government will give you when you're purchasing your first house. Now, through one way or another, not a lot of people are actually qualifying for this, but there are some sorts of conditions that you can sort of look at to see if you qualify. If you do qualify, great. If you don't, move on. The maximum income, so $95,000 for a single, $150,000 for a household or a couple. You can potentially get, and then you need to be contributing to KiwiSaver again for the minimum of 3 years, but you can potentially get $1,000 per year up to 5 years to purchase an existing home. You can get $2,000 per year up to 5 years that you've been contributing to KiwiSaver to purchase a new build. So that means if I'm purchasing a new build property and I earn $95,000 and I've been contributing to KiwiSaver for 3 years, I'm going to get $6,000 from the government that I don't have to pay back. Now, the other condition that I sort of glossed over and I didn't mention is that there are regional house price caps for this grant. I think it's $650,000 in Auckland for an existing property, an in-situ property, or $700,000 for a new build property. So you can see that the house price caps aren't really keeping up with the average house price. So that's usually the clincher where people don't qualify for it. But if you do qualify, apply for the grant, get it, you don't have to pay it back. So buying a house. Now, this is the piece that I sort of talked about before where I said, I'm going to try and give you as much information without boring everyone to death. I can't cover everyone's sort of specific circumstances. So just get on Slido and just start putting the questions in there. It means I can answer them or try and answer them on the fly, or I'll answer them at the end. So the general process, saving a deposit, we've talked about that. We talked about setting goals and budgeting. The next piece is organizing finance. If there's one thing you take from today, from me, it is please, please, please organize your finance early. It is heartbreaking for us when someone comes in and is like, hey, I found the perfect house. I need the money tomorrow. You know, we're going to go to the auction. There's just no way it can be turned around that quickly. Speak to your broker, speak to your banker well in advance so that you have a pre-approval. When you see a house, you can jump on it. You're not going to lose the auction because you don't have the finance. I'll run through buying a house and due diligence. So a couple of different ways you can actually buy a house, and then what to be looking out for when you're doing your due diligence, and who are the professionals that you need to involve in as well. Structuring your mortgage, we do that at the end. I won't spend too much time on that today, but if you have questions about fixed interest rates versus floating interest rates or something like that, chuck them in Slido and I'll answer them. And then settlement, that's when we actually get the house. It's when we exchange money for titles through our solicitors. Again, I'm not going to spend too much time on that because it's all fait accompli pretty much by the time we get there. But I'll focus on those sort of 3 key points in the middle. So finance, buying the house, due diligence. Just those 2 pretty much. Cool. So organizing finance. Please do it as quickly as you can or do it as early as you can. It can take a while. It can take up to sort of 2 weeks to actually get finance sorted with a bank. So you want to make sure it is sorted well ahead of time. Now, when a bank looks at a mortgage application, they generally look at 3 things. So your deposit, your income, and your expenses. Now, on the deposit side, we've talked about using KiwiSaver. They will want to see some genuine cash savings as well. So that's always important. If you're purchasing with less than 20% deposit, which is the standard that the banks usually require, they will definitely want to see that you've saved a portion of that as well. So it's important to have some savings in there, although we can get around it every now and then. Now, another, I guess, important point to raise is that when people are purchasing their first house, what's fairly common now is they'll get a gift from their parents. Sometimes this is actually a loan in the background that they pay back to their parents, but you will need a sort of a gifting certificate that the bank has, and or that you can give the bank, and that'll just tell the bank that, hey, it's not a loan, no encumbrance on the title, and you're not making regular repayments. So just keep that in mind if you are getting a gift from your parents or something like that as well. There's some other ways that you can structure that. Maybe your parents don't want to give a gift. They do want to give you a loan. You can do it as a deed of acknowledgement of debt where it's paid back when the house is sold. Again, a little bit complex there, but it's just different ways that you can sort of build up that deposit so that you have enough to purchase your first house. Your income. The bank is pretty much going to assess your income as it comes in. There's some tricks we can do there. We can add borders in. If you're buying a house with 2 bedrooms, you might be able to have a border in the house. That will increase your income because they're paying you on a weekly basis. You might be able to borrow a little bit more. But generally speaking, the bank's going to take your income, shade a little bit off for risk. If you're self-employed, they're going to shade a lot more off for risk. And then we can sort of, once we have the income established, we then look at the expenses. All we're doing there is looking at what is your average spend, what are your fixed commitments. So do I have loans that I'm repaying? Do I have credit card limits? What are my fixed expenses? We take those expenses, minus it from your income, and the amount that you have left over at the end of the month is how much you can use for a mortgage. Now, what does all of that really mean? Income minus expenses is how much you have left over for that monthly payment. We calculate your borrowing amount based on that. You will see in the media at the moment a lot around fixed expenses, and I got declined from a mortgage application because I used Uber Eats once or Deliveroo once, or I went to Kmart once. That's not 100% honest. It's not really 100% true. If the fundamentals of an application are right, it's not going to matter if you're spending a little bit and going out to eat or on Deliveroo and that sort of thing. It's more of a media beat up. The banks are still open for business, so they will still lend you money.
Like when you said it's not true, I thought you meant nobody uses Deliveroo.
Does Deliveroo even exist in New Zealand?
No, you're showing your UK roots.
Yeah.
If I can just ask you a quick question on the mortgage application organizing finance. This is on the assumption that people, I think they can get finance. What if I've never applied for a mortgage before for my first home, and I don't really know where I'm at in terms of how close I am?
Yeah, talk to a broker. I'm not sure if you're setting me up for that one, James, but talk to a broker. The reason I would suggest a broker over a banker is that, one, they have more time and they can sort of give you a lot more advice and guidance on the process. It's fairly quick for me to run some calculations and figure out how much you can borrow. So you may not need to go through an entire bank application. I might be able to say to you, okay, you can borrow $700,000, got $100,000 deposit, X, Y, Z. Do you want to borrow more? How do we get there? And what are some levers that we can pull? A banker can't give you advice on how to borrow more. They're very restricted on the amount of advice that they can give you because they're not usually financial advisors. So my first port of call, if it's your first time and you just want some advice or maybe to sound it out, would be to speak to a broker. Just quickly on organizing the finance, if you have less than 20% deposit, so over 80% loan to value ratio, you're going to get some fees on that application. Just consider it a little risk premium or an insurance for the bank, or just a way that they can get some more money out of you. I usually charge you a couple of percentage over the standard interest rate. So different banks do it differently, but just keep in mind that actually it's going to cost you a little bit more. The other thing with low deposit lending is that it has what we call higher test rates. So you need to earn more to be able to borrow the same amount of money than if you had a 20% deposit. So what that means is if I got 10% deposit and I earn $100,000 a year, let's say I can borrow $600,000. If I have 20% deposit and I earn $100,000 a year, I might be able to borrow $700,000. So if you can get 20% deposit, it's a really positive thing for your application. It means you can borrow more. It takes a lot of the risk out from the bank's perspective.
Obvious follow-up question off the back of that, Mike, is should I wait and save a 20% deposit, or should I buy a house earlier with a smaller deposit?
I'm always going to advocate for buying a house and getting on the property ladder earlier, because again, if you're trying to save, what you're battling against is rising house prices. Whereas if you get in the market, you are paying down. If you purchase now, yeah, it's going to cost you a little bit more, but you're paying down your mortgage. You're not paying someone else's rent, and the value of your house is rising as the same as the market, which means that not only are you paying down to get under 80% loan to value ratio, but the actual value of your house price is increasing. So it means you get there faster usually.
Awesome.
Cool. So due diligence. Now, let's say you've got your finance sorted and you're out in the market, okay, I can borrow $800,000. I've got a $200,000 deposit. I can buy for $1 million. What do I need to be looking at when I'm looking at these houses? So due diligence. First thing I would suggest is get a builder's report on the house. It is very tempting to get a mate who's a builder to come around and look at the house and go, yeah, looks great. Don't worry about it. Please don't do that. Get a builder's report and get it written down. We actually have a scenario where some customers of ours bought a house. Luckily, it was an investment property for them, not an owner-occupied property. They got a builder's report on the property. Luckily, they got a written report, and it turns out that the foundations were completely shot and the house wasn't livable sort of 6 months later. The building report didn't pick this up. However, because they got one, and because the builder should have picked this up and it was all written down, it means they have a case and they can sort of try and recoup some money outside of their insurance companies. So it is extremely important to get these and get them on the properties you're looking at.
If I can touch on that as well, Mike, the market's maybe not as hot as it was at points last year, but when you're going to, especially at auctions, and you're spending the money up front and then you get destroyed in auction, spend the money up front, get destroyed again, you can be, and this happened to me, I lost a whopping 5 auctions before I got my place. You can end up going like, it's just a waste of money. I probably won't get the house anyway. I'll just skip it. And I have been in auction rooms before where there's a couple jumping up and down who've just won their auction, paid for it, and I've gone, you don't know about the rotten wall between the house and the garage, do you?
Yeah.
So it's non-negotiable, really important stuff.
Yeah, absolutely. So a couple of quick points on there as well. Make sure they look at the roof. Make sure they look at the foundations. If the property is built between a certain time period or it's plaster, you may need a weather tightness report on the property. Again, if you're working with a broker, we can look at this and tell you straight up, like, hey, I think this might need a weather tightness report. We need to get this signed off by the bank before you actually go bid on it. Again, it just helps the process when you're looking at properties. If you buy a leaky house and you commit to buying it and the bank finds out that it's leaky or requires a weather tightness report, they won't settle the property usually. So you will be stuck with a property that you have to buy and you can't get funding. So super important if you're buying plaster houses from a certain time period to make sure that you've checked out the weather tightness as well. But most of you probably won't run into that anyway. Solicitor's due diligence. It is important that you get a property lawyer to look at these things. It's very attractive to just go to someone like the conveyancing shop, no disrespect to the conveyancing shop, and just get them to do the whole thing for $700 plus gist or something. But if they're charging you $700 plus gist, and a normal solicitor is going to charge you maybe $2,000 to do the due diligence and conveyancing, they are cutting corners somewhere. They have to be. So it's important you go to a proper solicitor who specializes in property to do this due diligence. What will they be looking at? First of all, they'll be looking at the title and the limb. The title on the property is how that property is registered with the council. And that will also show how it's owned, any interests on it, any caveats on it, And there's generally some points that you should know about the property as well. So it might say that it's leasehold, cross-lease, freehold, all of these sorts of things. It might be, hey, the current owner's ex-wife has a caveat over the property, which means it can't be sold because there's a caveatable instrument on there. So there's a ton of stuff that you just need to look at, that you need your solicitor to look at and review and just give you the rundown of what you need to know. They'll also look at the LIM report. This is more to do with the land that it sits on, services and these sorts of things. So this is going to look at that. The other really important thing they will look at, though, is the sale and purchase agreement, the SMP. This is the contract you are signing to purchase this house. There can be a million different things input into a sale and purchase agreement. We've seen conditions about COVID and long settlements. Sometimes we see paragraphs in there about this house has been sold essentially as is, where is. That means that usually when we see that, it indicates to us that there's unconsented work on the property, which you'll need to know about because a bank might not settle it. So there's just an array of different things in the sale and purchase agreement that you'll need to know, that you'll need a solicitor to look at and point out to you so you're aware of before you sign it. Now, one last piece of due diligence is you may need a registered valuation. Now, if you have less than a 20% deposit, you're probably going to need a registered valuation on the property. This is a thorough inspection where a valuer comes out, assesses the house, goes top to bottom and says, I think it's worth this amount. They can do this off the plans if you're buying off the plans, or they can go out and actually visit the property. Look, this is the really tough one where it starts to run up costs if you're losing auction after auction after auction, because these can be sort of $900 to $1,000 a pop. There are some ways around this. Again, if you're working with a broker, probably good to talk to them about your specific situation. And just keep in mind, these can take up to 2 weeks. These guys are absolutely slammed. So it's important to, if you do need one, you order it early. Cool. Purchasing process. I'm only going to cover off an auction and purchasing off plans really quickly because I have been going on for a while now. These are probably the two most common in New Zealand. James likes to say that, I don't know, I think people in Wellington buy by tender, is it, or negotiation or something? I don't know.
Hey, you can't be hating on the people of Wellington, okay? Lots of tenders happening in Wellington.
South of the Sky Tower, mate. I don't know where it is. For an auction, just keep in mind, again, have your finance sorted up front. This is unconditional bidding when you are bidding on a property. So if you win the auction, you've got to buy it. There's no conditions on these offers. You've got to have your due diligence done. You've got to have that finance approved for this. You'll be bidding up until the reserve price is met, and then the auctioneer is going to say the house is on the market. Different auctions or different auctioneers, I guess, sort of run things a little bit differently. But generally speaking, this whole process is designed to get more money out of the bidders. You are going to have the auctioneer pointing at you, telling you, he needs another 5,000, this sort of stuff. So just keep in mind of your budget when you're in an auction. It can get a little bit out of hand. Again, because it's unconditional bidding, just remember that purchase deposit has got to be paid usually within 24 hours of the auction being completed. So if you're using your KiwiSaver for that upfront deposit, you've got to give your KiwiSaver provider a heads up that it's coming. Also, give the estate agent who's registering you for the auction a heads up that you're going to be using your KiwiSaver as well, because it might be a little bit late coming through. The second way I'm going to cover is purchasing off plans. So if you're buying your first house, purchasing off plans can actually be a really good way to do it. Like James and I have sort of alluded to here, sometimes you can lose auction after auction after auction, and it's going to end up costing you a bit in due diligence each time. Purchasing off plans is slightly different. You are purchasing a house that has not been built yet. You're paying a fixed price and you're paying it from a developer. So already what happens is you may not be sort of missing out on 2, 3, 4. So it's going to reduce your upfront cost. You will get the house usually within 12 months, which actually can be a good thing when you're purchasing your first home, because it gives you 12 months to actually continue saving up that deposit. Now, again, you need a specialist property lawyer to run through this and look at the terms in the sale and purchase, because they're pretty long. You get 10 working days to complete your due diligence. That can be kicked out to 15 working days, but usually it's 10 working days. But by the end of that 10 working days, you should have due diligence done, finance absolutely completed, and be ready to pay the deposit.
Cool. Okay. So I'm just going to pause for a second. Nadia, I mean, I don't mean to pick favorites out here, Mike, but Nadia's asked 3 really good questions. Just a reminder that at the end, which will be coming very quickly, we're going to do some Q&A. So you can either pop it in the live chat in YouTube or use the Slido link in the description. I'll just touch on a couple of points that Mike's already mentioned. First is, if you don't know how close you are or how close you are to being able to purchase a property, or there's a property you're interested in, get the conversation started earlier. Talk to a mortgage broker. It's just, I mean, there's not a better deal, whether it's Mike or a broker you're already working with. The mortgage brokers are paid for the bank, and you will get personalized service and also be able to look at all of the different banks available. One might potentially say no, the other might say yes. One might offer you less, the other might offer you more. Have that conversation early.
Yeah, just to jump in there, we're paid by the bank, not for the bank. You said for the bank. We don't usually charge people for our services. We're paid by the bank.
Very good point. Building reports, non-negotiable, very important. Registered valuations, when required, are something that need to get done. Mike, do you want to maybe touch a little bit on registered valuations?
Well, I mean, I went through it in the last slide, but they're probably going to cost you, like I said, sort of $1,000. A building report might cost you 250, 300, maybe 400. And your all-in due diligence costs from your solicitor, 1,800 if it's simple, maybe up to 2,500 if it's a bit more complex. But, you know, generally speaking, about 2,500 to 3,000 really all in for your due diligence and conveyancing if it's easy. You will usually get cash back from the bank though that will cover this. So they will give you a cash contribution. So usually $3,000, $4,000, something like that, which you can use to pay this.
Cool. Okay. And those few bottom points, avoid emotional buying. Make sure that you are like Schwarzenegger in the Terminator, where you understand that you're just making like mathematical decisions. You're not getting bought into this property too much. You understand what it's worth. The way to do that is by understanding the due diligence around doing your due diligence. So what are houses selling for in the area recently? How does this compare? Leads on to the next point. The real estate agent might seem like a great person, but they work for the vendor at the end of the day. So make sure you are doing your own due diligence. They will try and amp you up at the auction. Make sure you decide beforehand what your cutoff point is. And finally, if it's on auction, clean offers just make it so much simpler. If you put like 4 conditions on your house purchase and somebody else puts none or 1 with a little bit less money, depending on the seller's situation, they might take the cleaner offer.
Yeah.
Well, just battling to get there. We go.
Cool. So I've been talking heaps. So I'm just going to run through some quick scenarios around buying a house and where people are at, because quite often the question that we sort of, I guess, get asked is, I'm too far. I think I'm so far away, you know, from buying a house. And when people actually talk to a bank or a broker, we can tell you're actually a lot closer than you think. So let's say you're 27, your partner's 29, you earn 75 and your partner earns 70. You have a student loan, your partner doesn't. You try and save between 500 per fortnight, and you've both been in KiwiSaver for 5 years. So to purchase a $950,000 house, reasonably speaking, you'll need a 10% deposit. Let's say you've got 35K in your KiwiSaver and your partner has 25. Let's say you've got that savings of 35K. Well, that is already at that $95,000 mark. So again, by having little bits here and there, the KiwiSaver, the savings, that sort of thing, you're already at that 10% mark, and you should be able to afford that house. For a single, let's say you're 27, you earn 100,000, you have no student loan, you're saving 500 a fortnight, and you've been in KiwiSaver for 7 years. So 10% deposit, 67.5. Your KiwiSaver 37,500, and your savings should be able to get to 30,000. That gets you that 10% deposit that you need to purchase a house. We've based these scenarios on specific houses. I know you're probably looking at me going 675 for a house.
You're full of it, Mike.
Yeah, that's ridiculous. I'm not. I based this on a specific house. It was a townhouse in Massey.
Okay, so I really want to jump to the Q&A. I just want to touch on when you do end up purchasing a home, or really at any stage, if you've got responsibilities around you or you are dependent on your income is your biggest asset. So it's really important that as part of this process, you look to put income protection insurance in place. So income protection is if you get sick, which unfortunately does happen, that you have insurance and the insurance company will pay you so you can continue to pay your mortgage, you can continue to maintain your lifestyle. If you have a partner or dependents, you probably also want to be thinking about life insurance. Now, sometimes people go, oh, you need like all of this life insurance, and it's this really big dollar figure where you're paying a lot. Something is better than nothing. And there's always levers you can pull to make it cheaper to pull it within your budget. But life insurance, income protection, and getting a will are all really important things when you purchase a house. And for those that say, I'm bulletproof, kind of like Mike and I after having COVID, we feel indestructible at the moment walking the streets. We're aware we can get COVID more than once for the record. There's a 24% chance that 1 out of a 30-year-old couple will be disabled for 6 months or more before 65. And unfortunately, an 18% chance 1 out of a couple will pass away before 65. So these things do happen. The reason we're bringing it up is people come to us when these situations do happen and go, James, Mike, can you fix it? It's a very hard thing to fix in hindsight.
Yeah. Cool. So some key points from today. And guys, we're getting towards the end of the presentation. So just start firing in those questions and we'll get answering them in a little bit. So have a plan, set those goals, know your numbers. So know if my plan is to buy a house, what does that mean in a numbers sense? How much do I need to buy this house? Budget. That is going to be the way to get you to achieving that goal. Budget, budget, budget. I know it's boring. I know it's got a bad rap. It's the B word. I know. But, it is the thing that's going to get you to achieve that goal. I mean, obviously, I put this one in here. Organize your finance early. Please, please, please. Like I said, it is heartbreaking when someone comes to us and they're like, I want this house. They don't have the finance sorted. The house sells within their budget. They could have afforded it, but they were just too late on that. And then KiwiSaver. Think about the contribution, think about the fund, think about the provider. It's a half-hour conversation. The numbers that James put up are accurate. It can be a huge difference when you come to retirement, but also when you go to use it as your deposit as well.
Cool. So if you want some help taking the next step, in the description to this video, there's a couple of links. So one is to book a time with a mortgage broker at Lighthouse. There's no obligations. There's nothing like that. Just have a chat and see how we can help you. So maybe you're quite close and you're looking to buy a house. Maybe you're a little bit earlier in the journey. You can book a 30-minute chat in the link in the description with one of the mortgage brokers at Lighthouse. Did you want to say something there, Mike?
No.
Okay, cool. The other one is if you're looking to build a financial plan, looking for advice on KiwiSaver insurance, that's the wealth team that can help you with that. There's a link there as well to book a free 30-minute consultation as well. Obviously, you're on our YouTube page at the moment, and this is a great spot with heaps of content. So if you want to hit the subscribe button, you can look at things where we talk about interest rates, we talk about low deposit lending, we explain different money jargon, which is what Money Bites is all around, volatility in the market. Today is hopefully just the start of you taking control of your financial future and continuing to educate yourself. So I will stop there, Mike, and I will read you a couple questions.
Yeah, cool. I can't see the questions. You're going to have to do them all.
Yeah, that's cool. While I do that, I'll also, for those that haven't seen, in the description, there's a link to Slido. So this is a good way where people can vote for questions. There's a QR code in the corner if you want to scan into that. Or I've got just a few in the YouTube live chat, which I'll ask you, Mike. Cool. The first one is from Nadia. Thank you for all the information. Can you please give it advice for those who have a 10% deposit at the moment, banks are very cautious regarding cases with less than 20% deposits?
Yeah, okay. So there's a couple of things in there. I'll start on the bank side of things. Banks are sort of not really any more cautious than they have been previously. It's sort of more just the amount of money that they can lend out with people with 10% deposits is a little bit less now, their whole lending book. The credit criteria hasn't really changed for those lenders. So my advice for people with 10% deposit is absolutely, I think you should work with a broker for this because there are tips, there are tricks we can do. There are ways that we can sort of improve the application. That means you can borrow a little bit more. So my advice would be speak to a broker, tell them you have a 10% deposit, tell them, how much of the houses you want to buy, go through the process with them. Not all banks are exactly the same. Each bank has slightly different credit policy. 99% of it is the same, but each of them has sort of different nuances. So you might be saying to me, okay, Mike, I've got a 10% deposit and I can only afford a 1-bedroom house and I want to buy in Auckland and I earn X amount. Then we might be looking at ANZ, for example, because they might have slightly better credit policy for you. If you're buying a 2-bedroom house, well, I know that actually the Westpac's credit policy is slightly better there because they'll accept border income and they'll accept border income that isn't capped at a certain amount per week. So just little bits like that mean that you can increase your income to be able to borrow a little bit more than you sort of otherwise would be if you just go to one bank. So again, if you've got less than 20% deposit, it's about the nuances of what bank you're going to, especially with the test rates being so high at the moment as well. But yeah, look, again, banks are open for business. They want to lend money. They like getting people into their first houses. Work with a broker. They'll take you to the right bank, and then they'll have a really good discussion with you about how to structure your lending, because you'll get a low equity premium if you have less than 20%. So an additional piece of interest that you have to pay on top of your normal interest cost. So you don't want to lock that in for like 5 years. We have some customers, most recent one, they went to Kiwi Bank. The Kiwi Bank locked them in for 5 years with a low equity premium of 0.75%. So if the market is paying 4%, you pay 4.75% in interest, and they lock that in for 5 years. It's terrible advice. I'll go ahead and say it. So yeah.
Mike, is 0.75% for as a top up for the low equity margin, is that like pretty common as a percentage?
0.25 if you've got 0.25 if you've got between sort of like 15% deposit, 10% deposit is 0.75. So it's just in stratas on the way up. But you locking that low equity premium in for a long time is a ridiculous thing to do if house prices are increasing, if you're paying the mortgage down. So again, that's the sort of advice that you should be, or discussion you should be having with a broker around how do I get this low equity premium off as quick as possible.
Cool. Okay, Mike, Nadia's back with another banger of a question. What potential changes will happen in July to August this year in terms of bank rules regarding loans, and especially for cases less than 20%?
Oh, I don't know.
I think
what you're talking about is the repealing of the triple CFA regulation.
Yeah. Do you want to very quickly touch on what the hell is triple CFA and then what might potentially be changing?
Cool. Okay. And the reason I said I don't know there is because no one really knows at the moment. So the triple CFA regulation, Credit Contracts and Consumer Finance Act update was brought in at the end of last year. Now, that was brought in to really target or to stop predatory lending for vulnerable borrowers. The externalities of what the regulations, I guess, have brought in is that actually a lot of people who are low risk are now finding it harder to access credit from banks. So due to, I think, every broker this side of Australia complaining, or actually in Australia as well with their own version of it, and some pressure from the banks, it looks like the government is going to repeal some of those changes to make it a little bit easier for banks to lend money. They are not changing the underlying credit policy, though. They are just changing the reporting and regulatory compliance on top of it. So again, it's not so much that it's going to be it's not really that you're going to be able to borrow more. It's just going to be that you're going to be easier to borrow money, if that makes sense. There may be some changes in there that mean you can borrow slightly more, but it's not like credit policy will be getting easier. It's the regulatory compliance on top of it that will be getting a little bit easier.
Cool. Okay. So in summary, we're not sure.
Well, yeah, really, because what you're seeing in the market at the moment is a lot of things like banks. They say I go to Uber Eats too much, or I eat out too much, and that sort of thing. What's missing there is the banker can't actually tell you how to borrow a little bit more, how to make the application seem better. What the banker is saying is that your regular expenses are too high and you need to reduce them. And they're pointing out ways that you can reduce your regular expenses by not going to Uber Eats, by eating in, these sorts of things. Fundamentally, if the application is still good, it will still get approved. It's just that it's a little bit harder and takes a little bit longer at the moment. But towards the end of the year, Nadia, you're correct. It will be easier for people to borrow money. Unlikely that you'll be able to borrow significantly more, but actually getting access to the funds will be a bit easier.
Cool. Let me ask you another question, Mike, and this time maybe a little bit less on the fence. Let's get to those good answers.
Okay.
Bank interest rates doubled last year. Do you have any information about the upcoming year? Do you think the exact same thing is going to happen with interest rates doubling again?
I don't have any information, and I don't think anyone has any information.
Get the crystal ball out. Let's get this rolling.
Yeah. So okay. So the predicament that the Reserve Bank is in is that they're using monetary policy to fight inflation. Now, monetary policy is a really effective tool for tightening demand side pull inflation, but not supply side push inflation. So they will continue to raise interest rates over the next 24 months to try and fight some of the inflation that we're seeing in the economy. However, what they risk doing is stalling a fairly stagnant economy by taking away people's disposable income. What does all that boil down to? Yes, interest rates will continue to rise. How long will they continue to rise for? My prediction is the next 12 months, not the next 24 months. I don't think they will double. I'll see monetary policy is most effective in New Zealand when your average interest rate sits around 4.5 to 5%, maybe a little bit higher. So I think you'll probably see that 2-year rate come in at around 5%.
Cool. Last question at the moment. So please ask any more questions you have. Do I need to sign a sales and purchase agreement for new builds to get the 10-day due diligence?
Yes and no. Sorry, yes. Look, so you can do the due diligence without signing that agreement. It's just that it means someone else can come along and sign that agreement from underneath you, which means they can then do the due diligence. And at the end of it, they have the house. So you can get the contract and you can get all the information you need and you can do the due diligence without signing the contract. Again, though, it just means that someone else can buy the house out from underneath you or reserve it. Remember, though, that, again, if you're working with a broker, this should be fairly easy, but that in that 10 days due diligence, you have the right to exit the contract for a number of reasons. And one of those reasons is usually finance. Now, if you've got a good solicitor and a good mortgage broker, if you got halfway through the due diligence and thought, crap, I don't want to do this, I want to do something else, or I've actually kind of changed my mind, I like another house better, your broker or your solicitor should be able to get you out of that pretty easily. I mean, I'll just send an email and say finance has been declined. But if you're working with a banker can't do that. A banker can't email you and say finance has been declined when it hasn't. So just keep in mind, make sure you got a good team and working with the right professionals, and you should be fine. But you can sign that 10 days due diligence and pull out of it pretty much at any stage.
Cool. Okay, Mike, I think we're going to wrap it up there.
There's actually a question in Slido. Did you answer it?
The one, is it a lot harder to buy a house this year opposed to last year?
No, it was the one that was like, what was the name of the budgeting app that you mentioned?
Oh, I can't even see that one.
Okay. Either way, it was Pocketsmith. Yeah, really good company. We do a lot of work with them. They're really good.
Great. Okay. We will wrap it all up. We will send this out as a recording for everybody who's missed it, if you'd like to book a one-on-one session, that we'd love to talk to you. Please, everybody, fill out the survey. Look forward to seeing some of you for tomorrow's session around paying down debt and growing your wealth, and then also Thursday for investing 101.
Do you want me to answer the other question in there?
I can't see what you're seeing.
Okay. The other question there is how important is it to build a credit score before buying a house? And what's the best way to do that and how to check it? Credit scores in New Zealand don't work like they do in America or the UK or overseas. You'll always see on TV, because the shows are American or British, generally, people being like, I need to build a credit score. I need to get a credit card to get a credit score. Credit scores overseas can be negative to neutral to positive. In New Zealand, a credit score is either negative or neutral. So you don't need to take out a credit card to try and build a credit score. That is true in the UK and the US predominantly, but not in New Zealand. We only run a negative to neutral credit score. So if you've never had a credit card or never had any debt, so long as you're running a bank account that is fine, you're not going to be adversely impacted by not having a credit score because it'll just be neutral. However, if you've had debts that you haven't repaid or you haven't repaid them on time, you'll have a negative credit score. If it was a while ago, we can usually get around it. But sometimes we just need to see three months of clean credit history.
Cool. Have we got any more questions, Mike?
Let me refresh it again.
I know, because I don't know what's going on my end. I'm lucky I've got you.
No, I think that is pretty much it.
Great. Okay, we'll wrap it up. Great. Thank you for all the questions. We'll see some of you tomorrow and hopefully talk to some of you one-on-one.